Greed and euphoria are powerful emotional drivers in the stock market that can lead to irrational decision-making, often resulting in overvalued markets and subsequent crashes. Here's how they manifest and affect market behavior. 1. Overbuying and overvaluing. Greed kicks in when investors become overly optimistic about future returns, pushing them to buy stocks in the hope of quick, high profits. This leads to overbuying, where prices are driven higher than the underlying company's actual value. During periods of euphoria, investors may ignore basic fundamentals, focusing instead on the potential for massive short-term gains. 2. Speculative bubbles. Greed, fueled by euphoria, is often the driving force behind speculative bubbles. When investors become excessively optimistic, they start bidding up the prices of stocks or sectors without regard for realistic valuation. This creates a feedback loop where more and more investors pile in, causing prices to surge, often to unsustainable levels. Examples include the dot-com bubble in the late 1990s and the housing bubble leading up to 2008. 3. Fear of missing out, FOMO. Euphoria often triggers FOMO, where investors rush into the market simply because they see others making large profits. This herd mentality exacerbates the buying frenzy, leading to a sharp, unsustainable increase in stock prices. FOMO often causes investors to ignore signs of market overheating and to make decisions based on emotions rather than fundamental analysis. 4. Ignoring risks. When greed and euphoria take over, investors often underestimate or ignore the risks involved in their investments. They may believe that the market will continue to rise indefinitely, ignoring signs of market overvaluation or deteriorating economic conditions. This risk-taking can lead to significant losses when the market corrects. 5. Euphoria drives excessive leverage. In euphoric markets, investors may borrow money, leverage to buy more stocks, believing that the good times will continue. While leveraging can amplify returns, it also magnifies losses, and when the market turns, those who borrowed heavily can suffer devastating losses. 6. Sudden market corrections. Greed and euphoria set the stage for market corrections. When the bubble finally bursts, prices can drop rapidly as investors begin to realize that stock prices were unsustainable. Fear of losses takes over, and the market experiences a sharp sell-off, sometimes leading to a crash. 7. Long-term damage to confidence. After a period of greed and euphoria, many investors experience significant losses when the market corrects. This can damage investor confidence, leading to a more cautious or risk-averse approach in the future. In summary, while greed and euphoria can drive short-term gains, they often lead to irrational decision-making, overvalued stocks, and eventual market corrections. Investors who focus on long-term, value-based investing and maintain discipline during times of market excitement are better positioned to avoid the pitfalls of greed and euphoria.